Hello everyone. This video is about fundamental analysis. What is fundamental analysis? Fundamental analysis is the examination of the underlying forces that affect the well-being of the economy, industry groups and companies. As with most analysis, the goal is to derive a forecast and profit from future price movements. At the company level, fundamental analysis may involve examination of the financial data, management, business concept, and competition. At the industry level, there might be an examination of the supply and demand forces for the products offered. For the national economy, fundamental analysis might focus on economic data to assess the present and future growth of the economy. The stock market investments are considered as one of the most risky mode of investment, mainly because of the fluctuations in the security prices. Therefore, before taking any kind of investment decisions, investors should do proper research and analysis of the stock market. This fundamental analysis and technical analysis helps the investor to make better investment decisions. Under fundamental analysis, we are studying the intrinsic value of the security. Here, intrinsic value means the real value of the security, or else we can say the true economic worth of the financial asset. Here, this fundamental analysis it involves three components. They are economic analysis, industry analysis, and company analysis. Under economic analysis, we are studying the entire economy, that is the growth rate or gross domestic product, etc., to see whether to invest in that economy or not. Then under industry analysis, we are studying the demand and supply of the products produced by those industry to decide whether the industry is performing well or not in the economy. Then the company analysis comes. Under company analysis, we are studying the financial statements of the company or management of the company, etc. To forecast future stock prices, fundamental analysis combines economic, industry, and company analysis to derive a stock's current fair value and forecast the future value. If the fair value is not equal to the current stock price, fundamental analysis believes that the stock is either overvalued or undervalued, and at the market price will ultimately gravitate towards the fair value. By believing that the prices do not accurately reflect all the available information, fundamental analysis look to capitalize on perceived price discrepancies. Here, as I already said, fundamental analysis is conducted mainly to calculate the fair value or else the intrinsic value of the security. Once the intrinsic value is calculated, we can compare the current value with the intrinsic value to see whether the security is undervalued or overvalued. Based on this value, we can decide whether to invest in the security or not. Therefore, fundamental analysis is very important. Components of fundamental analysis. The fundamental analysis consists of three main parts, that is economic analysis, industry analysis and company analysis. Economic analysis. Economic analysis is a study of the general economic factors that go into an evaluation of a security's value. The stock market is an integral part of the economy. When the level of economic activity is low, stock prices are low, and when the level of economic activity is high, stock prices are high, reflecting a booming outlook for the sales and profits of the firms. An analysis of the macroeconomic environment is essential to understand the behavior of the stock prices. The stock prices fluctuates mainly because of several economic factors. Therefore, investors are concerned with those factors which affect the performance of the organization where they are willing to invest their money. So, studying those economic factors always gives them an idea about the future corporate earnings or dividend rates or interest rates, etc. Therefore, this economic analysis is conducted. Here there are several macroeconomic factors which has impact on the economic analysis. Here let's see the different economic factors which are affecting the economic analysis. The company analyzed macroeconomic. The commonly analyzed macroeconomic factors are as follows. First one, gross domestic product. The GDP represents the aggregate monetary value of the goods and services produced in the economy during a specified period. Decline in the GDP indicates a potential economic slowdown. A high GDP growth rate is advantageous to the stock market. Here GDP means the monetary measures of the market value of all the goods and services produced in a specified time period. Here if the GDP is good, investing is better in that particular economy. If the rate of GDP is low, then it is not advisable to invest in that economy. Therefore, analyzing the GDP is very essential. Savings and investment. Growth in the savings naturally leads to more investment. High capital investment means possibility of more production, more demand and supply, better prices in the future and consequently higher business profits and a positive outlook for the stock market. Here, in case the investment rate in the economy is high, it will lead to increase in the demand for the security. When there is high demand for the security, it always leads to increase in the prices of the securities. Therefore, it is very essential to see the investment rate of the economy. Inflation. Inflation refers to a situation where too much money is chasing too few goods. Inflation indicates a rise in the price of the goods and services along with the growth of GDP. If the inflation rate is also increases, then the real rate of growth would be very low. Here inflation leads to increase in the prices of the commodity. At the same time, it decreases the money value, which is not good for the economy. Therefore, we have to see whether the inflation rate is high or low in the economy before investing money in stock market. Interest rates. Interest rates have a direct impact on the economy. The base rate of the banks affect the cost of borrowed funds. A decrease in the interest rate implies low cost of finance for the firms and more profitability. An increase in the lending rates affect negatively firms which depend on banks for their working capital and growth requirements. Here the financial institutions, here the organization, they can raise their capital either by issuing the securities to the public or by borrowing loans. Many companies or organizations depend on banks for their working capital requirements. Whenever for these kinds of institutions, these interest rate fluctuations are always disadvantageous. These organizations, we have to see whether the interest rate is good in the economy or not if we want to invest in these kinds of organizations who are dependent on banks for capital requirements. Balance of payment. The balance of payment is the record of a country's money receipts from abroad and payments to foreign countries. The volatility of the foreign exchange rate affects the investment of the foreign institutional investors in the Indian stock market. Here, balance of payment, it may be surplus or deficit. It may show surplus or deficit. If the balance of payment is showing a deficit, it affects the foreign exchange reserve, causing a negative impact. At the same time, a surplus in the balance of payment leads to a positive impact on the foreign exchange reserve of the country. it may either attract more foreign investment in our economy, or it may lead to decrease in the foreign investment. Then next one, monsoon and agriculture. Agriculture is directly or indirectly linked to many industries. A favorable monsoon leads to higher demand for these inputs and a bumper crop and more disposable income in the rural areas. This leads to progress in the stock market. When the monsoon fails, agricultural production and hydropower generation decline. They cast a shadow on the share market. Here, agriculture is considered as the backbone of our economy. Therefore, agriculture has a higher impact. If the monsoon is good, agricultural sector will perform better. It will lead to better impact on the economy. On the other hand, if the monsoon is not good, then it will lead a negative impact on the agricultural sector, which will have a negative impact on the entire economy. Apart from the above mentioned factors, there are many other factors which have impact on the economy. They are as follows: budget and fiscal deficit, tax structure, foreign direct investment, investment by foreign institutional investors, that is FIIs, international economic conditions, business cycle and investor psychology, infrastructure facilities, demographic factors. These are some of the factors which has impact on economic analysis. It is like gross domestic product. If it is higher, it is beneficial. Savings and investment. If the investment rate is very high, it is beneficial for the security market. Inflation rate should be low if the investor is supposed to invest in that economy. Interest rate fluctuation will have an impact on the organization which are depending on bank loans. Balance of payment, surplus and deficit both have positive and negative impact on the economy. Monsoon and agriculture also has impact on the economic analysis. Other than that, budget, tax structure, this business cycle, investor psychology, everything has impact on the economy. Here economy consists of several factors. Any changes taking place in any one factor can cause fluctuations in the security prices. Therefore, the investor must conduct economic analysis before taking investment decisions. So we can say fundamental analysis involves economic analysis, industry analysis and company analysis. Several factors of the economy has impact on this economic analysis. After studying the economy, we have to conduct an analysis of industry to see whether it is beneficial to invest in a particular industry or not. For that, we have to conduct an industry analysis. It is the next part of fundamental analysis. It is all about economic analysis, which is the first component of fundamental analysis. Thank you.